Hi, good afternoon. Welcome to the marketplace. Coming up, President John Mahama announces intentions to reopen the domestic bond market and re-enter the international capital markets to secure funding.
We're working to reopen Ghana's bond market in collaboration with the IMF and our development partners, the Ghana Stock Exchange, and local banks. However, future borrowing will be linked to self-financing commercially viable projects.
Question, is it the right time to do so? We'll discuss ahead. Also coming up, President Mahama signaling government will not extend IMF program, but we'll hear from Daniel Kojo, who's the country managing partner at Deloitte Ghana, who says an extension is essential to support the ongoing economic recovery and ensure stability.
For us, we are not saying that IMF should completely take over. What we are saying is that where we are, we need to solidify it. We need to ensure that we have a full grounding.
Plus, Bank of Ghana rules out any target rate for cedi's appreciation, insisting current good run is supported by positive market sentiments.
As much as we don't want it to be, depreciating excessively, we don't keep a target to which we expect it to get to.
We will analyze the implications coming up. Don't go anywhere. Well, thanks for staying with us. My name is Darrell Kwao. President John Mahama has announced intentions to reopen the domestic bond market and re-enter the international capital markets to secure funding. Speaking at the 9th CEO Summit in Accra, he emphasized that any funds raised will be managed diligently or differently, assuring that it will not be business as usual in terms of utilization and accountability.
Reopening domestic and international capital markets. We're working to reopen Ghana's bond market in collaboration with the IMF and our development partners, the Ghana Stock Exchange, and local banks. However, future borrowing will be linked to self-financing commercially viable projects, particularly by MDAs, MMDAs, and SOEs, ensuring value for money and sustainable repayment. The third is strengthening sovereign funds and local government financing. We'll amend the Public Financial Management Act and Constitution to make contributions to the sinking and stabilization funds mandatory. It will not be optional. So a certain percentage of funds must be committed to the sinking and stabilization funds. We also intend to empower MMDAs to issue infrastructure and municipal bonds secured against a portion of their district assemblies common fund to fund infrastructure projects such as roads, schools, water systems, and local industry in the districts.
Joining me on Zoom is economist Professor Patrick Isuming to discuss this. Good afternoon to you. What do you think, sir? Good timing. What indicators should be considered to determine whether Ghana is ready to borrow again domestically or internationally?
Good afternoon, and good afternoon to viewers. Thanks for having me. Well, let's start with opening the domestic bond market. I think that has to happen. Since we did the DBE, we have mostly relied on the short-term market to finance part of government deficit, which is a problem. Of course, opening or reopening the local bond market has to be done with caution. It's not something that we just open, and, because of what has happened before. It requires a lot of caution. So definitely that's something that I think has to happen. Also, going back to the international capital market, I'm not so sure. But I think it shouldn't be out of our thinking at the moment. We still have fundamental challenges in the economy that have to be addressed. I think the president should focus on. Let's fix the real sector issues. It appears that the recent strong performance of the city seems to have taken too much attention, and we seem to forget that the economy still has real problems. So I think when you have the kind of challenges we have, your focus should be on fixing the challenges and not try to get access to the international capital market. It's fraught with a lot of challenges and dangers. We've already seen it. So I think for me, that shouldn't be a priority at all.
Yeah, I mean, when you talk of the fact that there are dangers to it, what are some of those things that you think are risks if we should go ahead with this, especially with the international
I'm struggling to hear.
Yeah,
there's some breakages.
Yeah, I was asking because you said there are dangers to this. If you could tell us a bit more about the risks if we should go ahead, for instance, with returning to the international capital market.
Well, I think at the moment, I mean, we should make it clear. As long as we are in the IMF program, we are not going back there. It's part of the deal we've signed up to that we are not going back. So that is the first thing. But currently, global rates are not extremely kind to Africa. The Africa risk premium is still very high. And I think at the moment, we see that our reserves position are strong and the city is doing well. So it looks attractive to go and borrow. But that's not always going to be the case. So we've borrowed at the past at extremely high interest rates and not being able to service the debt is what has brought us here in the first place. So I think that we have to tread cautiously.
Yeah, and what would this also mean for debt sustainability, considering, for instance, our debt to GDP ratio currently?
So, first of all, I think once the currency appreciates, the CD value of the external debt just comes down. And of course, at this rate, I think the servicing is less problematic because the currency is extremely strong. So when we have to pay our foreign debt, it's much easier. But we have to understand that we are enjoying an unusually good time as far as the currency is concerned. And we shouldn't plan that this is going to last that long. So we shouldn't even be contemplating that. So it's so volatile, our current debt situation. Look, if the CD depreciates a little bit, you'll be talking about something completely different. So I think that as far as going to international capital market, we should put that in some feet and try and fix our challenge and try and focus on raising more domestic revenue to the extent that even if we go and borrow on projects that are self-financing, we're still not becoming one thing.
Yeah, and you say that it is okay to reopen domestic bonds. I'm just wondering, because the president talks about prudently using the funds, what mechanisms should be put in place to ensure these funds are properly utilized and are invested in productive sectors of the economy?
I mean, that comes with strengthening expenditure control measures. And I think in the last budget, the finance minister has made it clear that you need some clear certificate that has been approved by the ministry before any awards can be undertaken. I think that's good. But, I think there's still some looseness in our system that needs strengthening. And strengthening our overall governance structure. We know the president did speak about the SOEs and the municipals, but I'm not sure that we have the kind of strong controls there to prevent misuse of funds. Or if you take the SOE, they've been a big source of our debt in recent times. So I think perhaps we should proceed on that front portion. We need to build the systems that work. We've had a history of passing some control measures that only exist on paper, that are not implemented. So if you're able to strengthen the actual implementation of those controls, then perhaps we have a sound assessment for, judging value for money and confirming to ourselves that these projects are self-financing. Then we can consider those things.
Well, final question. I mean, you mentioned that the going to the international capital market is a no-go area whilst we are under the IMF program. But the president also signaling yesterday at the CEO summit that the government would not extend the IMF program beyond the May 2026 completion date. People are saying maybe you should. Where do you stand on this?
Well, since the election, I'm one of those who have been saying that an extension looks inevitable, but I think the president on many occasions has indicated that there's no such thing. Well, I think until and unless we've seen sustainable measures to address our fiscal situation, I think it will be premature to try and exit the program. Yes, this year's budget, the government has really reined in on its expenditure, but it's not something you can do every year. You know, because you just come out of election, it has a huge mandate, and it still has a lot of goodwill. It can implement the kind of tight budget that is implemented for 2025. It can't do that in 2026. Definitely not 2027 and 2020 when elections are coming out. So we need to see what we have done, the revenue reforms. Then begin to see those reforms yielding the required revenue for us to know that we are now on a sustainable path in terms of our public finances. We haven't seen that. I think the budget was read, addressed the expenditure side, managing the expenditure to ensure that they don't grow out of proportion. We haven't dealt enough with the revenue side. All we've done is just remove some of the taxes to bring some relief. But the fundamental question about how we are going to generate funds or revenues on a sustainable level to ensure that our public finances don't deteriorate, it has been addressed.
Yeah.
The president is able to address this before the end of 2026, then perhaps we could be in a position to exit the program. As I now haven't seen that yet, and so I'm not sure that we are ready to exit.
Very well. Thank you so much, Professor Patrick Isuming, for your thoughts and analysis this afternoon. I appreciate it. Thank you so much. You're watching The Marketplace. Well, as we talk about the IMF program, Daniel Kojo, country managing partner, Deloitte Ghana, says that extending the IMF program is essential to support the ongoing economic recovery and ensure stability. Listen.
What we have noted is that as a country, we've been reckless when the IMF is not in the room. So what we're saying is that we've seen with the IMF program, there's a lot of confidence in the system, and we've seen that has brought a lot of positive into the system. And it's part of all the things that we are seeing. So for us, we are not saying that IMF should completely take over. What we are saying is that where we are, we need to solidify it. We need to ensure that we have a full grounding before we can decide to do the thing. So that's what we are asking, if the government can consider a year or two more so that we can consolidate the gains that we have talked so far. That's all that we are asking, that because it is good, it has brought us to what we are seeing now, why not? A year more will not break anything. So that's what we are asking. Not that IMF should stay forever, but we think that a year or two more will keep us in check, and when the fundamentals are positive and everything's working, we can take that decision.
There's also a school of thought that we're seeing some gains now. Why don't we leverage and rather run our economy instead of seeking for an extension? What about that?
Yeah, so I think those thoughts are all good. So it depends. The question is whether our fundamentals are now resolved. So if we think that we are in that position where the issues, the fundamental lingering issues that keep coming back are resolved in terms of our economy base, what cocoa and the gold, those are the main two things, cocoa and the gold. And the prices can keep going up and down. If we think that we've got the structure right, then we are happy, we move forward. But we think that we need to take our time. We've started to see some groundwork coming up. And we think that a bit more time, and we are talking a very, very short term, a year or two more, and then we are okay that we can move on. But again, at the end of the day, the government see more than we can see, and we are only calling the government to consider.
You're watching The Marketplace. A quick break. When we come back, we'll be talking about the city. Don't go anywhere. Welcome back to the marketplace and to the exchange. The Bank of Ghana Governor Dr. Johnson Esiama has ruled out any target rate for the cedi's sharp appreciation against all major trading currencies. The governor gave the assurance at the Monetary Policy Committee press conference last Friday with journalists in Accra.
As much as we don't want it to be, depreciating excessively, we don't keep a target to which we expect it to get to.
Well, joining me on Zoom for the exchange's head of finance at Meban Capital, Nelson Kujo-Kwabeji. Good afternoon to you. So we had the governor there. What are the possible reasons, do you think, behind the Bank of Ghana's decision not to set a target rate for the cedi's appreciation?
All right, thank you very much, Aaron, for having me. Good afternoon. One of the reasons the Bank of Ghana has decided not to target rate has to basically with cutting down on speculative activities of speculators within the market. People are still holding foreign currency, and so they are just waiting to see the direction of the market. Then based on that, they can either hold or sell foreign currency. And so if the Bank of Ghana should go ahead and give a target rate, speculators will take advantage of that and do their speculative activity. So I think this is one of the reasons why the Bank of Ghana has decided not to set a target rate for the currency that is currently appreciating.
Well, wondering, though, how does a free floating exchange rate impact investor confidence and trade dynamics?
All right. So the free floating rate exchange system is one that is basically based on market dynamics with no or little government intervention. And so once it is based on market dynamics, what it technically means is that it links to predictability and also market efficiency. Predictability in the sense that investors or people who are engaged in international business transactions can actually predict how the market dynamics will go, and that will also affect their cash flow plan, or their cash flows. And so allowing the exchange rate to flow freely will boost investor confidence in terms of predictability and also market efficiency. Market efficiency in the sense that whatever information that they are getting from the market will be a real-time information that they can factor into their decision making.
Right. And so next question, what tools can the Bank of Ghana use to manage excessive volatility in the city without directly targeting a specific rate?
All right, so I think the Bank of Ghana has varied tools that they can use. Just recently, they have amended their cash reserve ratio, where they made it clear that banks must hold reserve in currency in which their deposit was mobilized. And so the cash reserve ratio is also is a tool that Bank of Ghana can use to manage the volatility of the CD without setting a specific target rate. And don't forget that the new cash reserve ratio is based on loan to deposit ratio. Then also the Bank of Ghana can also intervene directly in the market by either purchasing or selling forex in order to maintain or sort of manage the volatility in the exchange rate system.
Do you see any risks in allowing the cedi to appreciate significantly without intervention?
Well, one of the risks that is associated with excessive appreciation of a currency has to do with trade competitiveness. When your currency depreciates too much, what it means is that it makes your exports to other countries very expensive. And so consumers in those countries will find it very expensive to, buy your product. However, with the current dynamics of the Ghanaian economy, I think the appreciation of the cedi is actually boosting investor confidence. The cedi is an endogenous factor. We don't expect it to be static forever. Certainly, it will go up and it will come down. And so I think the benefit of an appreciating cedi will far outweigh any risk that is associated with an excessive appreciation of a cedi. So yes, export competitiveness could be a risk, but I don't think that is much of a worry because the benefit that businesses and individuals are getting from the stability and the appreciation of the cedi will far outweigh the trade competitiveness when the cedi excessively depreciates.
And my final question is, what measures can be put in place to guard against potential volatility from sudden inflows or outflows? In a minute, if you can.
All right, so I think what we need to do as a country is to have a balance of physical gold reserve and also forex reserve, so that when the prices of the gold is coming down, we can quickly release them and shore up our forex. Then again, if we realize that we don't have enough forex, we can quickly release the gold and then rake in enough forex in order to have enough to satisfy the needs of those who are engaged in international business transactions.
All right, thank you so much, Head of Finance at Melbourne Capital, Nelson Kujo Kwagoji. Join us for the exchange. Appreciate your time. And that's the marketplace, everyone. More news on our website, myjournline.com/business. Head over there for the day's latest stories. My name is Daryl Kwao. Thanks for watching. We will be back same time tomorrow.